You see a stock that's been dropping like a rock, but suddenly it bounces back up. You're tempted to invest. Is it a golden opportunity or a financial trap? Today, we'll uncover the truth about the dead cat bounce and why understanding it could save you from a world of hurt. Stick around, because at the end, I'll also share a proven strategy to tackle your debts faster than ever before. Welcome to Financial Futures 101, where we simplify complex financial concepts to help you make better decisions with your money. If you've ever wondered how to navigate the unpredictable world of stocks while managing your debt, this video is for you. Let's dive in. What is a dead cat bounce? First, let's decode this strange term. Dead cat bounce. It's a term used in the stock market to describe a temporary recovery in the price of a declining stock. Picture this. If you drop a dead cat from a height, even it might bounce a little. Grim analogy, but it's a powerful way to understand this phenomenon. Here's what happens. A stock's price plunges due to bad news or poor performance. Investors see the low price as a chance to buy, causing a brief price increase. But the stock drops again, often continuing its downward trend. This is a classic case of too good to be true. So, how do you avoid falling for it? Signs of a dead cat bounce. To identify a dead cat bounce, watch for these signs. No fundamental changes. The company's financials haven't improved, and there's no real reason for the price recovery. Low trading volume. The bounce is driven by a few optimistic traders, not a majority. Negative news. The stock's price is still overshadowed by recent bad news or performance issues. Short-lived recovery. The price spike doesn't sustain beyond a few days or weeks. Remember, a genuine recovery is usually backed by positive developments in the company or market. Always dig deeper before investing. Examples of dead cat bounces. Let's look at some real-world examples. Tech stocks. During market crashes, during the dot-com bubble, several tech stocks briefly bounced back after their initial plunge, only to fall further as the market corrected. Energy sector volatility. In the 2008 financial crisis, energy stocks experienced temporary recoveries driven by speculative buying, but continued to decline as oil prices fell. These examples show how important it is to analyze the broader market and company-specific factors. Don't get lured in by a sudden uptick. Always consider the bigger picture. Why investors fall for it. Why do so many investors fall for the dead cat bounce? It boils down to psychology, fear of missing out, FOMO. Investors don't want to miss what looks like a bargain or a turnaround. Recency bias. People focus on recent gains and forget the underlying negative trends. Hope. There's an emotional attachment to the idea that the worst is over. Understanding these psychological traps can help you avoid them. Always rely on logic and research rather than emotions. How to safeguard your investments. Here are actionable tips to avoid being caught in a dead cat bounce. Do your research. Analyze the company's financial statements, earnings reports, and industry trends. Use stop-loss orders. Set a predetermined price at which you'll sell the stock to limit your losses. Diversify your portfolio. Avoid putting all your money into one stock or sector. Follow expert opinions. Listen to seasoned investors and analysts who can provide a clearer perspective. Be patient. Sometimes the best action is no action. Wait for the market to stabilize. Paying off debt. Before investing, before you dive into stocks, let's address the elephant in the room. Your debts. Carrying high-interest debt while trying to invest is like pouring water into a leaky bucket. Focus on these steps first. List your debts. Write down all your debts, their interest rates, and balances. Prioritize payments. Tackle high-interest debts first. Credit cards, personal loans, while making minimum payments on others. Cut unnecessary expenses. Free up money to pay off debts faster. Negotiate with creditors. Sometimes, you can lower interest rates or settle debts for less than the full amount. Build an emergency fund. Save at least 3 to 6 months worth of expenses before investing. Once your debts are under control, you'll be in a better position to invest wisely and build wealth. Balancing debt and investing. If you're carrying low-interest debt like a mortgage or student loan, you might consider balancing debt payments with investing. Here's how. Calculate returns. If your investment returns are higher than your debt interest rate, it might make sense to invest. Allocate wisely. Split your disposable income between paying off debt and investing. Consult a financial advisor. They can provide a personalized strategy based on your financial situation. Remember, investing while in debt requires careful planning and discipline. Understanding concepts like the dead cat bounce can protect you from making costly mistakes in the stock market. Combine this knowledge with a solid debt repayment strategy, and you'll be on your way to financial freedom. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more content like this.